We're going to start out right over here, and I'll switch from this gold over to the weekly chart of the Russell, RUT, and this has our cycle analysis on there. So we're going to look at these cycles right in here, and you can see the clarity in the cycles, despite the fact that the Russell has been in a monstrous up move. Now, when you have this big cycle right in here, and these corrective periods don't bring you much of a decline, we call those right-hand translations. In other words, this minor cycle peaked on the right side of the ideal. The ideal peak would have been right over here. It peaked right over here and gave you a modest correction. This one peaked right about over here and gave you a modest correction. Those are very bullish occurrences. This right over here was a double star pattern that fooled me, as it normally would bring a top to the market, but then it surpassed that and it failed really and began to move up. And now you have this extreme swamped area right in here where a correction was due, and it didn't decline by very much. Because we've had these two very, very big upside moves in here, the likelihood is strong that when you get into this corrective phase over here, it will give you somewhat of a significant correction. Now, significant correction, well, you might say that's 5%. Would you call that a correction? Well, I would. You might say it's 10% or even 15%, because those are all corrections. If you look right over here at that large decline way back over there, of course, that was monstrous during that period of the beginning of the scare and lockdowns for COVID-19. So we have not had any real declines since that period. And now we're in this rising phase. It's either first week or the third week, I can't really tell, of that rising phase. And my assumption is that we're going to have a rather full-fledged correction coming up here. And that's been my assumption for the stock market for a long period of time, that it would rally up into January at some point, maybe late January, as you can see us projected right up over here, and then beginning a correction. Now, I'm going to show you something that really enhances this analysis, in that, why would I expect a correction to be coming? And that's because of a condition that I think is really overbought for the Russell. Of course, the Russell doesn't have a lot of earnings to it, and some 18 to 20% of them are considered zombie stocks, which are stocks that just have massive losses, may never even earn any money, and have been helped a lot by Fed policies, and now will certainly get some help from fiscal spending that's going to be coming up now that Democrats own the world. So that's going to be likely coming, but the markets already know that, and it's priced this in, and I'll show you how far it's priced it in a moment. So our projection right over here, when we look at this, is for some higher highs coming right now for a couple of weeks potentially, and then turning down. And right now we're projecting right over here to a number of about 1840. We'll come back to this chart in a moment, but I want to show you why I'm projecting that. This is a chart of the Russell that's probably a little bit different than you've ever seen. Let me just get it in here right now. This is a Russell weekly chart with the slim ribbon on it. So the slim ribbon offers you momentum conditions, and generally when the slim ribbon is really flat, you're not getting much momentum. As you see, the Russell really struggled during that period right over there, and then of course it had this big correction from the COVID scare. Now, well, scares, the reality of COVID, and I don't want to downplay that, because now we have had 4,000 deaths in a day, so it really is, of course, a nightmare situation. Now, if you look here, as you look back in these few years back, the disparity index, which shows you the amount over, in this case, the 13-week moving average, or the amount below the 13-week moving average, gives you conditions of slightly overbought or very overbought or oversold. And for a long period of time, it was like, so right over here, 7% overbought was a lot. And then when you got down over here, 5-6% oversold was a lot. That's the amount of distance above or below that 13-week moving average. That's the middle of the slim ribbon, the blue line. Here, of course, is that big break, and then something has changed now as volatility has increased, and this is what's important about this. We're now looking at levels of overbought or oversold conditions that have changed a lot. I want you to note here, this is the zero line. So this is when it approaches the 13-week moving average on the downside. It has not gotten worse than about 2.5% on the downside below that 13-week moving average at any time, all the way back since May. What is significant is when it gets above that 13-week moving average and how far it's likely to get. In this case, the overbought condition above that 13-week moving average was almost 12%. In other words, the amount above that 13-week moving average got about 12%, and then it lost about 13% of its value as it came back down to that 13-week moving average. If you look over here in August of this year, it also got significantly above. At this point right over here, it got to a level of about 9.5% above the moving average, and then fell 13% actually, as it got only down to 2% below the moving average right there. But it appears that there's some trend setting up in here where it can get up to some extreme level of 13% or so above the moving average, as it did right over here, and this about 10%. And then it started to be able to get up here in this buying panic that's going on, and now has reached the highest level right now of an overbought condition of about over 13% above the moving average. Now you could see the 13-week moving average here and how far above it is there right now, which is pretty extreme. So right now, if it fell back down to this really, which is a magnet, the 13-week moving average is a magnet. When it gets way above it, it's going to come back down to it. And if it got back down to it right over here, it would be a 12% decline from the high that we have. So the high may be in, it's not likely. As I showed, it's likely to be moving a little bit higher over these next couple weeks. But then because we're at this extreme level that we're talking about, it's likely to have a pullback of some significance. This one was about 3 weeks on the downside. This one in here was about 3 to 4 weeks on the downside right over there. And now what we're going to do is go back to the chart that I just showed you, which is that Russell 2000, and we're actually looking for a peak over here and then a decline from around February 1st to about March 1st, which would be a 4-week decline. If it were to give up about 12% as we're looking for, it would take it down to this very high level for a correction of the major 23.6%, which would take it down to about 1840 on the downside. That would be a 12% loss, and in line with what we see happening in the past of these corrections. Very, very normal occurrence, and why we think that this decline is coming through this period into this early part of March for the Russell and for the stock market. Then we have to see what happens in here. My bigger picture perspective, I don't want to give away too much of it, but I think there's a major failure coming in here where it comes tests where it's short of it or a little bit above it, and then the period out over here brings another very big down leg for the market. But that's further out there, and everybody's going to dispute that because, of course, the Fed is going to hold everything up. But I disagree with that premise moving forward.